At first glance, it looks like the US and China are locked in a brutal financial standoff. But to understand this economic tug-of-war, we need to rewind a few decades. Right now, both sides are playing hardball. The US is burdened with $35 trillion in debt and facing de-dollarization, yet it's raised interest rates to 5.5%. Meanwhile, China is enduring a sluggish real estate sector and a stagnant stock market, but still refuses to aggressively cut rates, instead slowly dripping liquidity like squeezing toothpaste. So what exactly are they fighting over? To answer that, we have to go back to the origins of U.S.-China trade relations. In the 1980s, the U.S. economy was booming. Labor costs were rising fast, and inflation was pushing up prices across the board. To cut costs and tame inflation, the U.S. began outsourcing low-end manufacturing, searching the globe for cheap labor. At the same time, China was in a quiet phase of industrial development, rich in labor but lacking capital and technology. The timing was perfect. The U.S. provided money and tech. China supplied manpower and factories. This kicked off over 2 decades of economic cooperation. China manufactured massive amounts of goods and sold them to the U.S. In return, the U.S. printed mountains of dollars, which flowed into China. America's money helped absorb China's goods, solving China's deflation problem. China's goods supported the U.S. dollar, reducing inflation risk. It was a win-win, clear division of labor, mutual benefit. But in the 21st century, everything changed. No new industrial revolution was in sight. The old tech dividend was drying up. The world shifted from growth to competition over existing resources. China had maxed out low-end manufacturing and began upgrading to high-end industries. But the U.S., with its dominance in both technology and the dollar, wouldn't tolerate challengers. So, an all-out economic war began. Tariffs were raised, tech embargoes imposed, and trade relations unraveled. The U.S. continued printing money, but without Chinese goods to match, those dollars became untethered. Currency supply far outstripped market value, triggering an inflation crisis. Imagine this. There used to be 10 apples for $10, so each apple cost $1. Now there are still 10 apples, but $30 in circulation. Prices naturally jumped to $3 per apple. China used to supply 20 extra apples to keep inflation in check. But now, they're not talking. The U.S. has to swallow it all alone. By June 2022, U.S. inflation peaked at 9.1%, the highest in 40 years. With inflation surging and the dollar weakening, the U.S. realized, old tricks won't cut it. It's time to bring out the ultimate weapon.